So the result is we have on our hands a credit crunch. Most banks are afraid to lend to almost anyone. They don't trust other banks and mortgage lenders. Mortgage lenders have tightened their lending standards now to the tightest levels we've seen in 18 years. Who are some of the victims in the mortgage meltdown? We've seen a run on the Florida Investment Fund, an $8 billion run in November. We expect to see more runs both in city, county, and state funds around the corner. The mortgage virus has spread into pension and other retirement funds. It's important to remember that there's not as much regulation in pension assets, and there's not as much regulation in insurance company portfolios. As long as it's investment grade, it's allowed. And so a lot of these things, because they were overgraded as AAA rated paper, they are sitting in what should be viewed as conservative portfolios, and in fact are not. So there are tens of thousands of pension and other retirement funds, and millions of 401ks and IRAs have now been infected with toxic mortgage credit paper. Money market funds are heavily exposed to the mortgage virus, as I mentioned. If a run on the money market funds begins, it will turn into a money panic, and the U.S. financial system will melt down. This could happen in Europe as well. There's growing municipal bond market illiquidity. In normal times, municipal bonds are very illiquid. In a credit crunch or time of financial stress, liquidity in the municipal bond market goes to zero. This illiquidity we see is spreading to other areas of the bond market as the financial crisis spreads. Bond insurance companies are in trouble. The 9 major insurers of over 80,000 corporate, municipal, and mortgage-backed bonds are in trouble with their own credit ratings being cut. ACA Capital, the major insurer of credit default derivatives, had its ratings cut from A to CCC, and we had MBIA just earlier this year cut from AAA to AA. These bond insurers cannot insure trillions of dollars in bonds and hundreds of billions in credit derivatives. They don't have the capital to do it. They've all been betting that no one would need their capital. And they've defrayed a lot of their risk exposure by derivative products, spreading that risk around. So they don't have the capital to cover the bets that they've made. It's like the FDIC insurance only covering 1% of the bank deposits in America. It's a charade. It's a total fiction to think that the FDIC can bail out the banking industry. When the bank out of Chicago went under in the 90s, in the late 80s, early 90s, that took 25%. The bailout of that bank took 25% of the FDIC's deposits. That was one bank. The collapse of the great bond rating scam, there has been incredible fraud and deception in giving inflated ratings to bonds and securitized debt and even to bond insurance companies. The 3 major rating companies, Fitch, Moody's, and S&P, have massively overrated hundreds of billions of dollars in CDOs and other credit derivatives. And you see, when you overrate something, you end up overpaying for it as a consumer. And if it's ever properly rated, guess what happens to the market value? It's immediately discounted. Financial ratings have been based on true value and must be based on true value. Value must be measured by market price. The ratings on the CDOs do neither. They were issued on artificially created securities that rarely had liquid markets, rarely had firm bid prices, and never could be properly valued on a mark-to-market basis. They gave these credit derivatives top ratings, which received pension funds and other investors, which deceived pension funds and other investors into thinking that they were buying, in fact, safe investments. The big 3 rating companies gave AAA ratings to 4 specialized insurance companies, AMBAC, MBIA, CIFG out of France, and FGIC, and these companies in turn insure the bonds and credit derivatives from default. So if they receive a AAA rating, they can then, for a fee, pass on that AAA rating to anyone who's willing to pay for it, as if the underlying paper is AAA. It's on a pass-through basis. These companies insure hundreds of billions in mortgage-backed securities. If the credit derivative had insurance, which was easy to get, the rating company automatically assigned the CDO, SIV, or CDS a AAA rating. Thus, the unsuspecting pension fund manager, investment manager, is buying what he considers top-notch paper. It doesn't get any better than AAA. And in fact, it's garbage. This is how $2.3 trillion in mortgage-backed derivatives or securitized packages of even credit card loans and auto loans as AAA ratings, that's how they received them and were then purchased in turn by investors all over the world. If the insurance company had AAA rating, whether it deserved it or not, the credit derivative it insured was also rated AAA, even if it was a junk bond, and most were. So in conclusion, the U.S. and global financial systems are more fragile and in danger of implosion than at any time since 1929, except that today we are 1,000 times more leveraged than then. So we've covered in this first section the concept of securitization, and we've seen how that spread paper products unsuspectingly into thousands and hundreds of thousands of portfolios globally. Leverage is also something that you need to meditate on and think about because it is a part of the problem, the second most important part. The subprime crisis is just a very small tip of a very much larger iceberg just beneath the surface. To date, we've had 3 bubbles. The dot-com high-tech bubble, we saw $8 trillion in damages and losses. The real estate bubble, in which we've seen $1 trillion in damages so far, but much more to come. The credit bubble with 300 to 400 billion in damages so far, but trillions more to come. And there are 2 bubbles to go. The consumer bubble, wherein the U.S. consumer has bought and borrowed nonstop for 36 years. Over-indebtedness and fear are about to puncture the consumer bubble. The credit derivatives bubble, a $51 trillion highly leveraged part of the gargantuan $681 trillion global derivatives bubble, is beginning to melt down. Now, the Fed and other central banks have one solution: drive interest rates through the floor and print money, create liquidity like there is no tomorrow. It will not work. You cannot reinflate a burst financial bubble. You cannot stop an avalanche once it's begun. Their solution, while it may save the market, while it may even post the Dow at 30,000, will destroy the U.S. dollar. And we will see, like in Germany, a hyperinflation, we think, accompanied by an inflationary depression. These events will push gold to several $1,000s an ounce and will destroy the purchasing power and viability of most traditional, non-tangible paper assets. The crisis is here. The crisis is now. This is not theoretical. Are you ready?